The first lie the market tells you is the one you repeat without thinking. Silver trades at spot. You see a neat number on a screen, 2 decimals, and your brain treats it like gravity. But that quote isn't silver. It's a reference point produced by a paper machine. Futures, swaps, and leverage stack up until price becomes about financing risk, not metal. Most days, the system looks clean because liquidity is thick and the plumbing works. Orders match, spreads stay tight, and exposure is available instantly, like a button. Then liquidity thins, inventories tighten, and risk limits snap shut, quietly, without warning. The paper system can turn ghostly, still printing numbers while physical slips away. A screen can look aligned even when the real market behind it is missing. That's how a quote becomes a comfort blanket, until stress rips it open. Real silver is not a candle on your phone. Real silver is metal with gravity and cost. It must be sourced, paid for, shipped, insured, and delivered into real hands. It ends up inside industrial lines that cannot afford to stop running. When that chain tightens, spot becomes a lagging indicator, not a leader. The screen prices financial convenience, the physical market prices scarcity. Scarcity doesn't negotiate. A factory doesn't debate narratives, it needs bars on time. If metal can't be secured, the paper quote becomes irrelevant to survival decisions. That's when the tell appears. Premiums rise while the ticker pretends nothing changed. Availability dries up, delivery times stretch, and normal quoting starts to vanish. The price remains visible, but the market behind it is quietly missing. This is why stacking matters. You're not collecting a number, you're collecting certainty. Stackers convert paper confidence into physical confidence, 1 ounce at a time. In calm markets, stacking feels slow, even boring, like nothing is happening. In stressed markets, stacking becomes an audit of what's real and what's promised. It exposes the difference between owning silver on paper and holding it in hand. When liquidity is abundant, that difference feels academic, like a technicality. When liquidity chokes, that difference becomes the whole game. So treat this like an investigation, not a quote. Stop asking, what does New York say? Start asking, where is metal clearing in size? Follow real buyers and real intermediaries, because they're the ones who can't fake it. Paper can delay reality with leverage and liquidity, but it can't erase reality forever. When liquidity dries up, the physical market takes the wheel and paper starts chasing. If the paper quote is a ghost, test it where real metal changes hands under pressure. Find the places where buyers aren't positioning, they're sourcing. That's why the Shanghai signal hits like a slap, because it's physical, immediate, and honest. While New York prints tidy numbers, Shanghai reveals what buyers pay for deliverable metal now. If Shanghai clears materially above New York, that gap is not noise, it's diagnostic. A few cents happens, $1 happens, but a wide, persistent spread is different. Persistent spreads mean the bridge of arbitrage is constrained, partially broken. In a healthy system, premiums attract supply and collapse. In a stressed system, they persist. A lasting premium implies silver can't flow freely from cheap on paper to needed in reality. Something blocks the transfer: logistics, inventory shortages, financing friction, risk limits, bottlenecks. Whatever the mix, the result is the same: the one-world price machine starts stalling. That premium becomes a flare, signaling supply you assumed existed isn't available at posted price. It's not just China pays more, it's paper losing authority through behavior. For stackers, this is where price and cost become impossible to ignore. Spot makes headlines. The premium tells you what it takes to secure metal when it matters. Stackers live in that gap, feeling it in stock outs, wider spreads, delayed shipments. The shelf refuses to follow the ticker down because physical demand didn't blink. Somewhere, silver is being bid like it's scarce, not traded like it's abundant. And markets don't need permission to resolve a gap, they resolve it when pressure forces it. If Shanghai keeps paying up, either Shanghai collapses or New York reprices. With impaired arbitrage, convergence doesn't happen gently, it happens in jumps. Repricing can feel like a teleport. Paper snaps to the level that clears supply. Physical scarcity plus constrained arbitrage doesn't argue, it forces settlement behavior. Now ask the timing question. Why does this widen right now? Not last summer? Spreads widen when shock absorbers are gone, and the most dangerous window is late December. Ghost week. Screens are on. Quotes print, but the human infrastructure runs half-staffed. Senior traders are out, risk managers tighten leashes, and desks run lean. Liquidity evaporates, the kind that lets you buy size without moving price. In normal weeks, depth absorbs orders. In ghost week, depth is missing. You're not trading an ocean, you're trading a drained swimming pool. Toss a rock into deep water and you get ripples. Toss it into shallow water and it hits walls. Thin books mean fewer resting bids and offers, so price travels farther to find a counterparty. That's why sudden $3 moves can look mystical on a chart, without context. It isn't mysticism, it's mechanics. When liquidity thins, markets lurch instead of glide. And timing turns tension into ignition. Shanghai says physical is tight. Ghost week supplies the spark. When the market is fragile, it takes less force to crack it. One motivated buyer can push price through levels that usually act like speed bumps. Once levels break, the move accelerates because there's not enough liquidity to slow it down. This is how repricing happens in minutes. Price doesn't decide. It gets yanked by absent resistance. For stackers, this explains the whiplash between screen and shelf during thin liquidity weeks. Spot may jump, stall, spike again, while physical premiums stay stubborn or climb faster. The supply chain doesn't refill just because a quote blinked. Ghost week is a runway for explosive upside, and a trapdoor for sudden drawdowns. Thin markets don't resolve truth. They exaggerate emotion and amplify mechanical flows. You can melt up violently, then snap down just as fast if a heavy sell hits emptiness. So the smartest posture is neither panic nor bravado, it's respect for speed and fragility. Confirmation won't come from your screen. It comes from places that can't fake it. That's why bullion dealer behavior matters. Dealers live in the gap between paper and physical. Dealers aren't arguing theory. They manage inventory, hedge exposure, and avoid getting steamrolled. In normal conditions, hedging is cheap and liquid, making reasonable premiums possible. In Ghost Week, that hedge turns into a problem, spreads widen, slippage rises, fills worsen, risk limits tighten, and the paper highway starts feeling like black ice. A dealer can go from hedged to exposed in seconds because plumbing becomes unreliable. Rational intermediaries widen spreads or step aside when the floor feels like it's cracking. Premiums rise because hedging costs rise. Availability tightens because restocking becomes uncertain. Quoting becomes selective because one bad fill can erase a week's margin. And when it gets ugly, you hear the most honest phrase, call for pricing. That's not marketing, it's risk management. Screen price is no longer usable for real inventory decisions. That's where stacking stops being a vibe and becomes an audit you can feel in your hands. The headline quote is a reference, not a receipt. The receipt is premium, availability, ship date. If spot dips but premiums don't, physical demand didn't blink, that's information. If spot rips but dealers go out of stock, the move isn't just paper excitement, it's supply stress. Multiple dealers freezing together is the same story as Shanghai, translated into everyday friction. If the dealer counter makes it personal, the futures curve shows it becomes structural. In healthy markets, later delivery trades higher because time costs money, storage, insurance, financing. When near-term trades above future delivery, the market is paying extra for metal now. That inversion is backwardation, an alarm bell that deliverable supply is tight. Backwardation undercuts the idea that paper claims can smoothly bridge time. It suggests collateral is being hoarded or strained, bending the timeline itself. Shorts who roll routinely now face rising roll costs. What was nuisance becomes a recurring bill. Backwardation taxes short exposure for staying short, regardless of the story behind it. Eventually, positions stop being a thesis and become a liability that bleeds. Some shorts choose the other exit, they buy back. Covering is buying, and buying under pressure is fast. Drop forced covering into Ghost Week liquidity and you get gaps that look supernatural. Offers disappear, bids chase, and price jumps to the next level where someone finally sells. Those air pockets aren't mystical, they're what happens when depth vanishes. A cluster capitulates, the market gaps, risk systems react, and margin pressure tightens. More shorts are forced to cover into even less liquidity, feeding a self-reinforcing loop. For stackers, backwardation is the paper market's involuntary confession. Deliverable silver is tight. Factories can't wait for perfect entries, so they pay up and lock supply, pulling metal out. Urgency moves faster than opinions. That's why spikes can arrive without headlines. Shanghai signals scarcity. Dealers confirm friction. Backwardation reveals stress in the plumbing. When all three align, the next leg higher feels less like a vote and more like settlement. Backwardation shows strain. The gamma wall explains how strain can turn into a vertical move. Key levels matter when they're crowded, especially around major option strikes. Options aren't side bets, they're steering wheels for dealer hedging flows. As price approaches a crowded strike, hedge sensitivity can spike dramatically. To stay neutral, dealers often buy futures, buying that pushes price higher. Higher price increases hedge need, forcing more buying, feedback that can run hot in thin liquidity. In deep markets, humans sell into strength and dampen the loop. In ghost week, the buffer is thin. A clean hold above a crowded strike can spark a chase without any new headline. Systematic strategies add a second engine, triggers flip, and capital deploys automatically. Trend, momentum, and breakout models don't debate, they react, adding demand when books are shallow. Trend, momentum, and breakout models don't debate, they react, adding demand when books are shallow. That's how 75 to 80 can happen quickly. Price teleports to the next liquidity pocket. But thin liquidity cuts both ways. One heavy sell can shove price back under the strike. Then hedges unwind in reverse. Dealers sell futures. Momentum reduces exposure, and price can drop straight. This is the whiplash that shakes weak hands, melt up and snap back without changing physical tightness. Don't confuse paper turbulence with physical resolution. The metal reality may be unchanged. If you're stacking, your compass can't be a 5-minute candle. You need an anchor. Zoom out and measure silver against gold, the benchmark monetary metal treated as balance sheet asset. Ask not, is silver expensive? Ask, how many ounces of silver equal 1 ounce of gold? The gold-silver ratio reframes sticker shock into relative value. Silver can look high in dollars and still be cheap versus gold if the ratio is stretched. That shift matters because mean reversion doesn't require a story, it only requires imbalance. If gold holds steady and the ratio compresses, silver's upside can be large without gold moving much. This is why some see silver as the higher beta catch-up trade when the cycle turns. Relative value strategies can reinforce demand. Buy silver. Hedge gold, purely on ratio signals. Those flows don't replace the physical thesis, but they can amplify it when volatility tries to shake holders. The ratio becomes psychological armor. It stops you from mistaking turbulence for destination. Now return to fundamentals, because charts lurch, but factories still have to run. Industrial buyers are shifting from just-in-time to securing future supply, even at higher prices. The cost of a shutdown is catastrophic compared with paying a premium for a critical input. That turns demand into a vacuum that pulls ounces out of circulation and into inventory buffers. Solar sits at the center. Build-out demand tied to policy, contracts, and capital budgets, not impulse. Electrification adds layers. EVs, chargers, grids, data centers, industrial electronics, silver quietly everywhere. The point isn't one application uses all silver. The point is multiple sectors scale at once. These buyers want reliability, not exposure. They stockpile to protect throughput. not to trade charts. When buyers stockpile, above-ground inventories, the hidden buffer, start drawing down. Once buffers thin, marginal buyers bid for the same finite deliverable pool. The market begins pricing availability instead of theory, and that's when premiums stay stubborn. Recycling helps, but it reacts slowly and needs sustained high prices to mobilize scrap. Strategic stockpiles, where they exist, aren't designed to smooth retail shortages or dealer shelves. Private holders don't sell quickly when they sense a regime shift, they hold tighter. On the supply side, mine output can't be switched on like a faucet, projects take years. Permitting takes time, costs rise, and much silver is produced as a byproduct, limiting responsiveness. Refining and logistics add friction, and volatile tape makes producers cautious with forward commitments. That reduces tradable float precisely when buyers are trying to lock metal up. Put it together and you get a structural deficit. Consumption outruns production, forcing repricing over years. This is where stacking becomes alignment, not reaction, retail discipline matching industrial necessity. Stackers convert paper claims into physical certainty, while manufacturers do it at factory scale. Mechanics explain the jolts. Fundamentals explain why dips don't end the thesis. If capital rotates from metal into leverage, miners become the second gear expression, late, then violent. But second gear demands risk controls, because miners can draw down brutally even in a bullish thesis. Now the endgame. Markets move on incentives, positioning, and timing, not just fundamentals. The final days of the year become a tug of war over closing levels and psychology. A strong year-end close becomes a performance marker, a marketing line, and a momentum trigger. January resets mandates, rebalances portfolios, and can inject size into a market already tight. In a stressed silver market, that can feel like the market woke up overnight. But systems fight back when price moves too fast, through breaks that slow tape, not solve scarcity. Margin hikes force leverage traders to liquidate, halts interrupt momentum, credit tightens, limits bite. None of those create new ounces. They only punish weak hands and buy intermediaries time. That's why the playbook is survival first. Don't treat thin markets like a scalping contest. Respect leverage. In a market that gaps on gamma, squeezes on backwardation, and whips on holidays, leverage kills. Stacking is the anti-leverage strategy. Fully paid positions that can't be margin called out of your hands. The goal isn't to win every candle. It's to avoid being forced out before scarcity reprices. Watch what's hardest to fake: Shanghai premiums, dealer behavior, delivery timelines, and the curve. Let paper turbulence be a warning label, not a compass, and keep your timeframe honest. When physical becomes boss, paper doesn't lead, it chases, then snaps to clear supply. The thesis is simple. Impaired arbitrage plus real demand forces repricing when liquidity can't hide it. The signal isn't a headline, it's behavior, premiums, stock outs, backwardation, and stress across intermediaries. When those align, price becomes a settlement process, not a popularity contest. Your edge is not speed, it's staying power, the ability to hold through mechanical noise. Survive the journey long enough for the fundamentals to matter, because they don't care about your entry. Paper can delay reality, but it cannot manufacture metal when factories bid for deliverable ounces. When the bridge is constrained, Resolution comes in jumps. Fast moves to the level that clears supply. That's why the most honest market is the one that must deliver, not the one that can roll. Keep your attention on the real-world clearing price, not the prettiest number on a screen. And remember, scarcity doesn't negotiate, it settles. If you learned one thing, let it be this: the quote is a reference, the receipt is reality. Reality is premium, availability, ship date, curve shape, and whether dealers are willing to commit. When the system is smooth, that feels academic. When liquidity thins, it becomes the whole game. This is not a prediction, it's a map of mechanisms that appear when the pool gets shallow. And mechanisms don't need belief, they only need conditions. Conditions are visible now: persistent physical premiums, constrained arbitrage, and intermediaries acting defensively. In that world, the screen can print anything, but the shelf can't. So don't get hypnotized by candles. Follow the behavior that can't pretend. If physical is tight, paper volatility is just turbulence on the route to repricing. Your job is not to guess the next wiggle. Your job is to stay in the thesis responsibly. Be humble with leverage, patient with accumulation, and ruthless with evidence. When you see the same story in Shanghai, dealers, and the curve, listen. That's the market speaking in plain language, even when the screen tries to speak in decimals. And when the market finally admits scarcity, price doesn't walk, it snaps. The only people still standing are the ones who weren't forced out before the truth arrived. So if you stack like an auditor, methodically, calmly, and with a long horizon. If you trade like a mechanic, respecting liquidity, levels, and the feedback loops that move price. Don't confuse motion with meaning. In thin markets, motion is often just plumbing. Meaning lives closer to delivery, scarcity, timing, and the willingness of real sellers to show up. The destination is implied, but the instruction is explicit: survive the journey. When you finish this film, don't remember the number, remember the test. Where does metal clear? If the paper quote is a ghost, the physical premium is the fingerprint it can't erase. Shanghai is the flare, dealer behavior is the translation, backwardation is the confession inside the curve. Gamma and thin liquidity explain the jolts, but they don't rewrite the physical picture. The ratio keeps you steady, and fundamentals explain why the story doesn't end quietly. In the end, markets are forced to reconcile claims with deliverable reality. The paper system can stretch time, but it can't stretch supply forever. When the bridge breaks, price doesn't negotiate, it clears at the level that brings sellers back. That's not hype, that's how scarcity settles when convenience fails. And that's why physical certainty matters in a world built on rolling promises. Hold the thesis with humility, measure with evidence, and let the mechanics do what mechanics do. If you want the cleanest signal, watch the people who must deliver, not the ones who can delay. When physical becomes the boss, the screen doesn't lead, it chases. And when it finally catches up, it often does it in a jump, not a staircase. The last frame is simple: